Hi, my name is Andy Ayim and I'm the founder of the Angel Investing School. I've been investing in startups for over 6 years, and today I want to talk to you about what angel investing is, how it kind of works, and how it compares to other asset classes from venture capital, property, and stocks and shares. So let's start with what it is. I want you to just quickly look at your smartphone. Look at all of the apps on your phone. You might see Google there, Facebook, Netflix. All of these businesses had individuals at the start of that journey that put their money at risk and invested into these opportunities. They often did really well with it. But that's what an angel investor does. They take their own capital and they put it at risk to invest into early stage businesses. The reason why that's important is because when you're getting started with these technology businesses, you need early backers that are going to put their money to use, but also their expertise and their networks to help you hopefully get success on that journey and grow a meaningful business. And all of those businesses that I mentioned started in that way. So now I want to talk about the criteria to become an angel investor. In the UK, the Financial Conduct Authority, the FCA, has certain rules under something called the Financial Promotions Act to govern who can and can't class themselves as an angel investor. It's really a protection to make sure that you can afford to lose money if it goes pear-shaped and you invest into an early stage business. So first we'll look at the definition of the high net worth investor. With the high net worth investor, this is someone who earns £100,000 a year or more in income, or is someone who has $250,000 or more in assets, not including your place of residence, your home. The second way that you could be eligible is if you class yourself as a sophisticated investor. So this is someone who has worked in the financial industry for 2 years or more, has been part of an angel group, also known as an angel syndicate, for 6 months or more, or you've previously invested in an early stage business, also known as an unlisted business before, in the last 2 years. And finally, you could be a director of a business which generates $1 million or more in revenue. So those are the criteria that you look for in the UK. And don't worry if you're not there yet, because to become a sophisticated investor, you can join an angel syndicate group, for example, for 6 months or more to be classed as someone who can then invest into early stage businesses. And finally, I want to touch on actually what the difference is between an angel investor versus other asset classes. Let's start with venture capital. Venture capitalists raise money from other institutions like pension funds or family offices or other high net worth individuals. And their promise is to try and 3x that money. So if I raise 100 million, I'm trying to return 300 million or more to my investors. So therefore, my whole business model is incentivized to try and find startups that are going to grow big enough, which we say $1 billion or more, so that I can afford to make that return to my investors. Angel investors are a little bit different because we're not raising money from anyone. We're putting our own money at risk. So actually, our motivations for doing so could be really varied. It could be because I've worked in the financial industry for the last 20 years. Therefore, I'm really passionate about investing into fintechs. Or it could be I see the lack of funding going to women or people of color. So I really want to back people from those communities. That cause is close to my heart. Or it could be because I'm really curious about an emerging technology like NFT or AI or blockchain. So therefore, I want to participate in that learning by investing into those industries. And if it is even for about that financial profile, again, it could look very different to venture capital. Let's take an example. Let's say there's a tech startup and they provide software, I don't know, for billing and payments. And that software startup ends up selling itself for £90 million. That founder could make a life-changing amount of money, right? 90 million is quite a lot and a majority stakeholder of their business. That angel investor could make an incredible return, right? They just sold for 90 million and you own 1% of that. One incredible outcome for you. For that VC fund that has raised 100 million, this is a nightmare scenario because they can't return their fund. They only own, let's say, 10% of that business. They might walk away with 9 million, but they're meant to return 300 million to their investors, so they don't like that outcome. So there you can see the difference between what a VC's outcome is versus an angel investor's. Now let's look at other asset classes like property. Property is a bit lower risk than angel investing because you're buying into a hard asset, a home, and you're essentially making money by either renting that out or selling that property. Maybe you added value by fixing it up. It's quite a linear path, it's quite low risk, it's quite predictable. Versus angel investing where actually 9 out of 10 of those startups that you invest in might fail or fail to make a return. So you really need to have this approach of building a portfolio and hoping that a small number of your portfolio could really win so big that it can basically account for your losses. And finally, let's look at stocks and shares. When we talk about stocks and shares, what we're actually talking about are companies that used to be privately owned, startups, that grew so big that they got listed on the public markets, like the FTSE 100 or the NASDAQ in America. So that's the journey that we've seen with the companies like Google, like Netflix. And what it means is now that it's publicly listed, anyone in the public can buy stocks and shares in that business. Whereas startups is private, it's not publicly listed. So only if you have access can you buy stocks and shares in those businesses. With the publicly listed businesses, again, it's quite risky if you're putting your money into one, but there's things like tracker funds where I can put it into 100 at one time, like the S&P 500, to invest into all of the top 500 companies in America. You don't quite have that in the private market, so that's where it's more higher risk because I'm putting my money to use into individual startups. So that was a comprehensive video, but hopefully it gives you an introduction into what angel investing is, the criteria that you look for to become an angel investor, and what the differences are between angel investing and other asset classes.